Imagine your money triples in a day. That's what happened to a select group of investors when Figma, the design software company, had its IPO.
The pop has still been more than tripling of that $33 price, and now it's above $100.
Design startup Figma's CEO is now a billionaire.
But can everyday people get rich from IPOs? IPO mania is back. In general, IPOs are a total insider's game, but there are some ways retail investors can get in on them. More companies went public than ever before in 2021. The next year, the stock market dropped into bear territory. Thanks to inflation and rising interest rates, investors became more cautious, and IPO activity faded as companies opted to stay private longer. But after a 3-year drought, there are a lot more companies getting ready to go public than there were in the recent past.
What we're seeing right now, I think it's fair to just say it's a revival, a resurgence. But really what it is a return to normal. We may expect to see 3 to 5 IPOs a week coming up in the fall, and maybe more in early 2026. When the last 3 years, we've been lucky to see maybe a dozen, 2 dozen large companies in a year.
That's right. More companies you've never heard of are suddenly in the news, along with companies you know, like Klarna, which lets you finance purchases, and StubHub, the ticket seller. When these private companies have an IPO, which stands for Initial Public Offering, ordinary investors get a chance to buy shares in them for the very first time, and the companies go from private to public. There are a few reasons the IPO market is strong.
You're seeing a lot of companies with cash flow and with good P&Ls actually coming to or at least thinking about coming to the IPO market. And the second thing I think is corporate confidence and CEO confidence and venture confidence. And then the third thing is watching transactions kind of issue successfully and perform successfully in the aftermarket.
There were 2 blockbuster IPOs this summer. Figma's brought a block party to the New York Stock Exchange, complete with a DJ, pizza, swag, and house music. The hype was electric. A unicorn is a privately held startup with a valuation of over $1 billion. Figma's unicorn IPO broke a record, rising 250% in a day before falling back to earth. The record Figma broke had just been set in June by Circle, a fintech startup that develops and issues stablecoins. There was hype around Circle's IPO too, partly because it's a crypto company. Before Circle, we hadn't seen a first-day gain like that from a company that raised more than $500 million in its IPO since Palm, the maker of Palm Pilot, went public in 2000.
Some of the things you saw in a company like Circle, the aftermarket performance in the week or two after the issue was just phenomenal. You take a quality company, which actually is a little bit of a different animal for the marketplaces and a little bit of a new concept, and see, the massive support it got in the secondary trading. That just builds that confidence equation.
It's been 3-4 years since we've seen quality growth IPOs. Investors really are just, have all this pent-up demand for these types of companies.
Earlier this year, the AI cloud computing firm CoreWeave had a pretty lackluster IPO. Then CoreWeave's stock quadrupled in an explosive rally.
It is essentially the first AI pure play to come to the IPO market ever. So we did expect to see more demand than it initially got. There was more news about AI maybe, but there was suddenly more hype around AI, and this big name that had gone public suddenly reemerged back into the spotlight and just started climbing.
So how can you make money off IPOs? There's a core group of people getting rich here: company insiders, venture capitalists, and institutional investors. For the average Joe and Jane investor, it's more risky and difficult. It's hard for retail investors to get in at the outset, especially when an IPO is super hot. Until recently, you could only get in at this stage if you were buddy-buddy with a startup backer. Some brokerages, like Robinhood, Webull, SoFi, and E-Trade, let their users request shares ahead of an IPO at the insider price, in Figma's case, $33. But you may not get what you request, and the hotter the IPO, the less likely the lottery will go in your favor.
You would apply for shares and, through a lottery system, possibly get shares if Robinhood is allocated shares from the underwriter. But this isn't guaranteed. And there are still rules to the shares that you own. Now, you have to hold them for 30 days, so you may not be able to take advantage of those early gains.
With Figma, holding the stock 30 days would have meant watching the shares fall from a high of $120 to around $70. The stock fell even more after the company released its first earnings report, meaning many early investors are now looking at a loss. This volatility is one of the big risks of IPO investing. We'll get back to risks later. The second option for investing in IPOs is to wait for the aftermarket, which means after the IPO.
It's going to hurt missing out on that big pop like we saw with Figma and Circle, but there's still plenty of time to find an entry point in the aftermarket where you're still able to gain access and take advantage of that really transformative period in a public company's life.
So the aftermarket trading has been, quite strong. Whether that's driven the overall equity markets or whether that's been driven by the overall equity markets is really hard to determine.
Facebook's IPO is one example where waiting paid off. The early days of Facebook's IPO were dubbed the face plant. The stock price fell 30% in the first year. But anyone who held on from those days could have cashed out with huge gains since. And if they're still holding on to 1,000 shares they bought of Facebook for $30 a share in 2012, that's now worth more than $750,000. Waiting means paying more for a stock right out of the gate. Those $33 shares of Figma cost $85 when they launched on the New York Stock Exchange, meaning retail investors paid a premium. A third way to invest in IPOs is to buy an exchange-traded fund that tracks them.
And this is a good option for investors who are looking to diversify their portfolio and without the hassle of researching and really understanding each individual stock.
The Renaissance IPO ETF tracks the stocks of newly public U.S. companies for the first 3 years. Another keeps companies in its portfolio for 4 years. Both are beating the broader market, which is a sign of the IPO market's health. But IPO ETFs can be volatile because, well, IPO stocks are volatile, especially in the first weeks and months, which leads us to the risks of this type of investing. After an IPO, stocks can take wild swings. Hedge funds often short IPOs, counting on a stock to plunge when the initial hype fades. Stocks are also vulnerable after their lockup period, the 3 to 6 month window of time in which company insiders aren't allowed to sell their shares. When the lockup period ends, all bets are off. Look at CoreWeave. The stock took big dips after its early summer success, including around the lockup date expiring. Volatility can also drive momentum trading, where investors buy as the stock is rising and sell as it's falling. This can make it hard to know when to get in. With IPOs, institutional investors and underwriters, usually large banks, often make out the best, along with company insiders. Still, Figma, Circle, and CoreWeave's performance mean demand from retail investors is red hot. And when companies see a strong aftermarket performance, it makes them think about how they might do on the open market too.
So what we're seeing in the private backlog right now is a lot of tech, kind of mirroring what we've seen in this pickup in new issuance over the past few months. A lot of tech, particularly digital assets and fintech. So names like Figure, Gemini, Kraken.
So what do you think? Are you ready to bet on a company you've never heard of that could be the next NVIDIA? Or flame out entirely? Here's what to look for: growing revenues and profitability, or a path to profitability. You can dig this up in a company's IPO prospectus. How does this startup's proposed valuation compare to its peer companies that are public? What challenges exist for the sector? Is the market still going strong? If you want to get in, one thing's for sure: you'll have plenty of opportunities to try this fall and into next year.